Well, good evening, guys. How we doing?
Doing great, Rick. It's week 7.
It's week 7, and I know that those are alligator tears I can see on your cheek there, right, Matt?
I had the hardest time sleeping last night knowing that this was our last time together.
I knew this. In fact, I had every confidence that would be the case. In fact, Diana has just been all a dither knowing that this round of, I think she called it torture, was just about to be done. I think
It was Kate, but I agree with her.
It was Kate. Okay. Well, and yeah, I'm sure you did. Well, it is the last night, guys. And so what I want to do, of course, as we've done every night, is take whatever questions are necessary with respect to the items you're working on. I then want to spend some additional time talking about elements that you might have curiosity about with the course project. And then finally, I want to walk through and have you develop with me a spreadsheet model that you might use for thinking about having localized this whole valuation decision and how you might think about a project within a firm that's not simply the whole firm itself, which I think you already have all the tools to do this and are probably well into them in your course projects. I just want to make sure we're all on the same page with this. So with that, what kind of questions would you have at the moment that I can help with?
I only have questions on the project, so I'll wait for that.
Okay.
I had a question on ICP in the last question, number 9.
And when you say ICP, are you talking about now the one that is due this week or the one that's due a week from now?
The one that is due this week.
Okay, that's what I supposed. I just wanted to be sure.
Yeah.
So that's DCF KVD, right, Diana?
And then it says from the potential buyer standpoint.
Right. So let me just set a couple of things up here for you, or for us, if you will. And we'll get ourselves going. Okay, remind me which paragraph are you in here? Because you're talking about, are you talking about a particular question or are you talking about some information that's in the lead into this?
Just the whole question and how you came up with different numbers in your solution, different like the percentage and stuff like that.
Okay, so we can talk about some of that. So if I'm looking at this from the perspective of a buyer, I'm not the firm anymore, am I? I may be an investor looking to invest in the firm, or a buyer looking to buy the whole firm, right? So if we're looking at this from the standpoint of a buyer or an investor, what discount rate would we use? You don't need to give me a number. Just tell me how we would label it and how we might describe it. Anybody can pipe in here. So since Xinjiang's got the best looking background tonight, just this whole pitch black deal, Xinjiang, if you were going to describe in discount rate terms what the perspective of the buyer or investor might be categorized, how would you describe it? Any help?
Can you repeat that again?
Yeah. So if we're talking about the perspective of the buyer, because that's the issue that Diane is asking about, we're gonna look at the perspective of the buyer in one of a couple of ways. We're going to look at it from a discount rate standpoint, and we're maybe going to look at it from an operating efficiency or operating expectation standpoint. So from the discount rate standpoint, what kind of a discount rate would an investor use?
Is it the WACC?
No, in fact, I think the WACC is the perspective of the firm, right? So the firm would be a seller rather than a buyer.
Is it the required return?
Exactly. Who said that? I could hear the voice. I just couldn't see whose mouth was moving.
This is Michael. It's me.
Hey, thank you, Michael. With the bright red lipstick, I should have been able to see that. So yeah, that's exactly right. So these would-be investors have an expected return of 12%. Those investors are buyers of investment, right? And the investment they're thinking about buying into is this particular firm. And they've got to earn at least 12% or they're not going to be happy about it. So Diana, that's the first part of your question. And that may be the majority of the question. But now we're going to recognize something. We're going to recognize that if you use all the same cash flows in calculating something from the standpoint of the seller or the firm, and the same exact cash flows when we calculate it from the standpoint of a buyer or an investor, but the only thing that's different is discount rates. And if we've gone from the firm's lower WACC to a would-be investor's higher rate of return expectation, then we're going to find that the present value of the firm goes up or down. So if the discount rate increases, the value goes up or down?
Down.
Down. And in this case, do I remember correctly that the discount rate was about 5.5? Is that right? The WACC? What was WACC in this case?
It was 5.520.
Okay, about 5.5.
From the seller.
Yeah, about 5.5. So if we now look at this from the standpoint of a buyer at a 12% return, that's more than double the return or the discount rate. So we would expect a significant decrease in the value that each of these two parties would estimate if the only thing that's changing is the discount rate. Well, so here we have Taylor, and Taylor's part of this company. In fact, he's the CFO, and he's walked in, and Diana, you have given him an offer to buy the company that's about 50% of what they would have expected based upon their estimation. And by the way, their estimation was backed up by some market values, wasn't it, Taylor? You guys, the estimation you guys come up with is around 100 to 114. The market values of your capital components are 110, so that's pretty well supported. And now Diana comes in with a estimation based upon literally a doubling of the discount rate, so maybe half the value. And she says, here, I'm going to offer you 60. If you know the market values you today at 110 and your estimations value you somewhere between 100 and 114, what do you say to her offer of 60, Taylor?
No.
Oh, Taylor,
No,
Taylor, you've not spent enough time in the boardroom. It is, you crazy wench, hell no. Okay?
Right.
It's something like that, right? So it's just absolutely not. It defies logic. But Diana, you're determined to buy the company, which means you've got to meet Taylor's expected price, don't you? So we're going to have to, from an investor or a buyer standpoint, we're going to have to find some efficiencies. We're going to have to find a way to increase revenue, maybe because the company that you already own has some synergies, or you've got a network where you've got some synergies, you can sell more, or you know you can expand it into another marketplace without too much difficulty, increase revenue. That would be a forecast adjustment for revenue, right? Best owner premium for revenue. And you know that if you add this company to your cadre of companies, you're going to get a better price on labor, you get a better price on input costs and such. Maybe you pick up a 4 or 5% improvement in some of your costs. Those are, again, adjustments. And by making those kinds of adjustments, you may well realize that even with your increased return expectation, you can meet Taylor's expectation and still eke out a nice profit. So if you're really looking at something from the standpoint of a buyer, an investor, then you have to look at it from the standpoint of their required return, but you have to know that if that's the only thing you're going to change, that the value is going to go down substantially. And if that's the case, you either have to question, was the value that they were already expecting overblown, in which case it's okay for it to have gone down, or as in this case, is it backed up by some market metrics? And if it is, there's no way that Taylor's going to accept an offer of 60 when the market has him at 110. So if you want this, you're going to have to find a way to see a clear path to that valuation, but at your discount rate. I think I said this to some of you as we were on a call together last night. This, by the way, is exactly how private equity works. Private equity, which is the biggest buyer of these kinds of companies, if you will, private equity realizes that there are some market instruments at play here, and we must meet the expectations if we want to own all or a substantial part of the company. In fact, sometimes you've got to pay more. You guys very often hear about companies in the open marketplace where there's been a tender offer, a bid for them, and the buyer had to pay more than the current market price. And we've talked through why that might be, of course. So can you find enough operating efficiencies that even at your expected discount rate, you're willing to pay that price or a little bit more?
So, hey, Rick, just to make sure I understand that, to kind of re-summarize it. So, I mean, basically just that relationship between the required rate of return and the WACC is basically that the WACC is kind of like a market set expectation of, you know, opportunity slash return. And, you know, if that's what the model states, if that's your discount rate, and somebody comes in and says, well, no, I want 12%. What you're saying is, okay, if you're going to apply that instead of the WACC, then the value, when just based on how the model works, if you input that as the new discount rate, that's just going to drive all those values in the model down, which is why if we just simply input that 12% instead of the 5%. And that's just because of the fact that somebody's expectations are out of alignment with the rest of the market. So is that correct?
Yeah, Matt, Matt, that's the perfect tie-in. That's the perfect tie-in. Because if you think you're going to get 12% for a company's capital components when their opportunity cost is 5.5%, you're up in the night, right? Unless you're doing something other than simply acquiring the capital components. And
meaning
pardon?
Meaning like looking at the company and saying, I'm not just going to acquire it, but I'm going to acquire it. And I'm going to come in and I'm going to implement a new vendor management system, and I'm going to redo their sales team and blah, 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 blah. All these different things that you look at in an organization and say, I can maximize these areas and make it more profitable.
Right. So think about it like this. If you're going to go buy a company, do you want to go buy a company that is running at perfect operational efficiency and it is eking out every bit of profit it can from the market in which it resides? Or do you you want to find a fixer-upper, right? Got good bones, good market, good products, good people, but that you can come in and make a difference.
It's kind of like the house analogy used before. Like if you're just shopping for a house to live in for 30 years, right?
Yeah.
That's one thing. But if you're shopping for a house so that you can then 5 years later sell it for $80,000 more or whatever, like you have an expectation that you're going to look for something that has the ability to improve.
Yeah, I want to buy the worst house in the best neighborhood, right? I want to buy the worst company in a good market segment that's got good products, because I can do something with that. At least I'm egotistical enough to think I can. Okay.
I have a quick question on that.
Please.
So when you're talking about WACC or required rate of return, like in my mind, I guess how I was thinking of it was like growth. Like, okay, required rate of return, like I want to get at least 12% growth, but that's actually not how you're thinking about it. It's a discount rate. So you're saying, I anticipate that this will experience a 12% discount rather than 12% growth.
Yeah, in fact, thank you for mentioning that, Kate, because we talked about this a little bit last night. Somewhere over the last 6 weeks together, and this is the first time, by the way, I've had this experience, and this is the 8th time I've taught this class to a group not unlike your own. So somewhere in our last 6 weeks together, we connected the concept of discount rate and growth of the company or growth of its revenues. Those are not connected values. There is no definite correlation between those values. there is a correlation between the discount rate that you would receive or that you input and an internal rate of return. But those are completely different than growth. So whatever I've said or done, and I apologize for this, 'cause I don't know, I've kind of looked back and I can't figure out how I did it. But whatever I've said or done that's caused you to conflate rate of return, or rather discount rate and growth, they are not correlated. Oh yes, when we've got a good rate of return, good growth is helpful. But the discount rate and the growth rate are completely disparate variables.
So like a smaller discount rate is better and a larger growth rate is better. Is that
Except for when?
if it's larger than the growth rate, or if the growth rate is larger than the discount rate?
Yeah. So remember our perfect storm scenario, and that is the Bella's running a company, and her cost of borrowing is like 2%. I mean, she's got just killer low cost of borrowing. The credit worthiness, capitalization, et cetera, is so great, and she's got a runway in front of her of 10% growth. Well, all of a sudden, we know that in the Gordon growth model and the continuing value part of the equation, we're going to have a negative outcome, right? And so we have to think about what's driving that. But again, don't conflate growth and discount rates. Discount rate and rate of return, yes. Discount rate and internal rate of return, possibly, but not rate of return or discount rate and growth.
And so for the ICP for question 10, you would just elaborate on how, because they anticipate a larger discount rate, should only be willing to pay less for that company because they anticipate a larger discount rate than the firm anticipates?
Assuming that there were no other adjustments that they were expecting to make, or cost or operating efficiencies. Yeah.
Yeah. Okay. But yeah, so that's true. But then, but we know that we can make these adjustments that kind of make up for that. And so then you could come up with a slightly higher value again.
Exactly.
Recover from that. Okay.
Yeah. So if we're looking at this and we're looking at the numbers in this problem set, again, simply the cash flows that we know about and the discount rate of 5.5%, we were coming up with a value of about 100 to 114, right? But then we made some adjustments. I'm going off of my solution set now. We made some adjustments and imposed a 12% discount rate, but the value of the company or the assets still fell because the expected adjustments weren't enough to overcome the drag on that higher discount rate. And you may notice if you go through here and look at my solution set, I don't have a question 10. And I don't have an answer to question 10 because your answers to it can be very deep or not. They can be very broad or not. I put in that question there to give you guys just a lot of latitude to discuss this issue. What else?
I had that question on adjusting interest expense.
Yes. So I'm going to go ahead and open up Mira Dravana, and then I'll share my screen. Bear with me. I apologize. I thought I already had this up this evening. I don't. Okay, I believe that you're seeing my spreadsheet on Mira Dravana. Are you not? Can I get some nodding or shaking of heads, please?
Yes.
Okay, good. Thank you. Come on. Just having to set some things up here. Okay, so there's a couple of different ways that you might think about applying an interest expense adjustment. So here we have an interest expense forecast ratio. You're used to how those come together. It's the interest paid at time one divided by the debt at the prior period of time. In this case, it gave us a 5.5%. If you were to look at how I built my models, in this cell, I simply put the change in the interest rate. Okay, so if I believe that I'm going to be able to go from a 5.5% interest rate to a 4% interest rate, then I would put, in this case, I think 1.5, and it's going to decrease. Okay, so I put the absolute value of the change. There's no necessary agreement on exactly how this kind of adjustment takes place. You need to input some methodology so that you can put a number here and adjust the interest expense to that which you think it should be. Maybe more importantly than how we think about modeling the change in interest rate, what would bring about a change in interest rate? Why would I be able to go from, let's say, 5.5% to 4%?
If they borrow or they refinance their debt?
That's possible. So if the company refinances their debt and at a lower rate than is currently evident by the interest and the debt relationship, okay. How else?
I mean, the purchasing company could just generally have a lower weighted average cost of capital.
Right. So so this company is acquired by Google. Google's cost of liquidity capital is virtually nil. Last I knew it was like 0.6%. Okay, and so the new owner has greater credit capacity, perhaps. So there's a lot of things it could be, but those are two good examples of it. But whatever you do here, you simply need to model the ability to adjust it to the rate that you want to see. Now you might choose, in this case, to instead of put in an adjustment factor, you might simply say, well, it was 5.5%, and you might put 4% in here, and to say, I believe it's going to adjust down to 4%, in which case you'd be fine as long as your interest expenses were calculated appropriately off of that. There's some pretty good agreement on how you do these kinds of adjustments of revenue and production, or rather revenue and operating expenses, but there's not great agreement on interest expense. Any idea why that might be? Is interest expense part of free cash flow? What do you think, Bella? Is interest expense part of free cash flow? Anybody agree or disagree?
I think it might be.
Yeah, you guys are scaring me now. So interest expense isn't part of the free cash flow equation. None of the inputs to free cash flow reflect interest at all. Why is that? Matt, why is that? Do you remember?
Well, I don't remember why. I'm guessing it has something to do with the decision that goes into, like, you could decide that there's a decision whether or not you have accrue interest or not based on how you decide to finance the company, right?
Yeah, so as it turns out, Matt, you did remember. That is exactly the answer. Okay, so yeah, it's a discretionary choice, and because it's a discretionary choice, then in most valuation models, it's not relevant. The only reason we have it in our forecast is because the APV model, the adjusted present value model, utilizes it in the tax shield. Remember that the tax shield is the interest expense times the tax rate. Well, the adjusted present value model, as I indicated to you when we first looked at it, is an interesting model that I only bring out to you so you can see that if you have multiple cash flows, that you may need to add them together, and they might end up having multiple discount rates, or they may each have their own discount rate. And so in this case, that extra cash flow comes from interest, but interest is typically not included in any of these models. It's only the AP model that we ever see interest. So it's seldom used. It's not talked about a lot. There is no agreement in the literature as to how this adjustment would take place. Does that help, Kate? Cool.
Yeah.
what else would you like to discuss before we start to talk more about the project? Okay, so let's discuss it then. Matt, what is the purpose of this project?
Well, to be honest with you, Rick, so I think the purpose is to demonstrate what we've learned in this class. But to be honest with you, when I read the rubric, I'm kind of confused as to what the actual final deliverable should really be.
Okay, that's, by the way, that's why we've talked about it several times, because it's something like vague, right?
Yeah, a little bit. So, like, for example, you know, one of the questions I had was, if you read the rubric, it says, I can't remember the exact verbiage, but one of the things it says is discuss how different firm inputs are used to calculate firm valuations. So when I think about that, I think to myself, well, when we say inputs, what are we talking about, and what valuations, right? And I guess the reason I struggle with it is because we've used some very specific terminology and formulas and very detailed level of slide decks and things like that. And then we come back to really high level. It's like, well, when we say inputs, are we talking about like market inputs? Are we talking about like the inputs in the calculations? Like, so anyway, I don't know.
No, I think that's actually a really good answer. So, so you think that it's in part to show or give you an opportunity to evidence what you may have picked up from the class, and you got this quandary of inputs because I'm something like very vague in the rubric and even some of the discussion in Canvas as to what this should look like, except for maybe the word count. You know, that's kind of definitive for you, right?
Right.
So Diana, I'll let you come off mute. What's the purpose, from your perspective, what's the purpose for you guys having to do this project? I'm not going to ask Kate because I now remember Kate's answer from last night.
So as Matt said, to demonstrate what we learned in the class for this 7 weeks or 6 weeks. And then we mostly learn about the different valuation models like FCF, KVD, FMM. So maybe we can do that, and then evaluate the firm, like to see if you want to buy that firm or if you don't want to buy the firm.
Okay, so the applying of decision criteria. Okay, Mandy, do you have any additional input as to what you think the purpose of the project is?
I mean, I could say what Kate said last night.
Well, you're welcome to, but then you also have to say something serious.
I think, sorry, my child's looking for her box. So I think the purpose of it is just to really take, Ashlyn, stop. Is to learn like how to apply this in real world settings, because we don't always have the same information. Like for my final project, for example, I didn't know how to calculate WACC because it's a private firm rather than having preferred and common stock. So it's just one of those situations where learning how to grasp all the pieces and put them together when they're not laid out right in front of you.
Yeah. So you guys will, if you think about this, you'll realize that from the first night of class and the first problem set and the first quick sheets, everything was very prescribed, right? I mean, ROE is equal to net income divided by total equity. Free cash flow is no plat plus depreciation minus change in net working capital minus net capital spending. By the way, there's no interest in there. And everything was just very prescribed, very laid out. But we have become increasingly interpretive with both what we use to get some of these inputs and how we interpret the outcome from them, including a whole series of decision criteria, and the way that Shenjiang might apply a decision criteria and David might apply it and Kylie might apply them would be very different based upon their particular needs, preferences, expectations, etc. So the rubric, Matt, And some of the description is purposely vague to give you guys all kinds of latitude as to how and what you discuss. It doesn't have to be exactly A and B and C. It needs to come from the discussions we've had in our class. It needs to come from some of the thought process that we've developed as we've spent the last 6 or now 7 classes together. And it needs to focus towards the ability to make a decision depending upon which decision criteria you find meaningful for the decision you're making. Mandy's company, or Mandy's project, is going to be about a family business. Andrew's project is about a nonprofit organization. Well, you want to talk about esoteric, try to think about how you apply valuation change for a nonprofit organization. One of you is thinking about, acquiring an entire business to put into your own, and everything in between. So you've got a tremendous amount of latitude. My whole reason for having a course project, my singular purpose for a course project is for you, well, I guess it's a dual purpose, excuse me, is for you guys to have an opportunity to realize that you have created a new lens through which you're able to look at some things and have some good critical thought process that goes through that lens. And you're able to adjudicate things in a way that you could not even conceive of doing so 6 and 7 weeks ago. So that's one of them. The other is so that I can see that you are able to thoughtfully consider a scenario in business, one of your own choosing, by the way, and work through making a decision as a function of that scenario and the inputs, discount rates, cash flows, time frame, decision criteria, revenues, operating expenses, whatever they happen to be, and do it in a way that you guys can show me that you thoughtfully considered this and you kind of get where we've been together. And I know that that's nebulous at best. Now, the good news is when you're given something that is so open-ended and so nebulous like this, then the grading of it tends to be rather generous. Because as long as you can tell me a great story and back it up, I'm going to buy it, right?
You had me at grading is generous, Rick.
I knew that, Matthew. I
think I guess my takeaway would just be, it sounds like, part of the reason it's a little bit vague is because it's to help demonstrate not just how to do all the calculations, but the conceptual understanding of what they mean. And,
yeah. Exactly.
Okay.
What else would you like to ask with respect to this project? Okay. So
tomorrow evening is okay if we would like you to take a look at it?
Yes.
By tomorrow. Okay.
Yeah. And so what Kate's referring to is for those of you that would like for me to review a draft of the project you're working on and give you some modest input, I'm happy to do that. I just need to have it in my hands or digitally have it by tomorrow night so that I've got enough time to look at it, get it back to you with some comments, and then you still have enough time to finish it up in a good way. But you don't need to send me a draft. I don't need to review it for you, but if you'd like me to, I'm happy to. I just need to have it within a week of when it's due so I can have some time to look at it for you.